Good afternoon, everyone. I'm Greg Major from Blueprint Wealth. Today we're going to have a webinar on how to boost your super, and we'll be looking at different strategies which will help you leading into 30 June to get more money into your super and hopefully save on tax as well. So let's jump in and start looking at some of the slides which will deliver those strategies for you in the lead up to 30 June. First of all, I just want to let you know that the work that we'll be going through today is general in nature only, and if you want to seek specific advice, please contact one of your advisors at Blueprint Wealth, but otherwise all of the information here doesn't take into account your specific circumstances, so treat it as general advice only. So today we'll have a look at a few topics. Why use super at all, and why is it an effective vehicle? We'll go through the sort of retirement that you think you'll be looking for and how much money you might need to have an effective retirement. And then we'll dig into the sort of strategies that will assist you to boost your super and grow that retirement balance, including things like why you should bother to consolidate, why would you want to put more money into super in the first place, and exactly how can you get more money into super to make it grow. So what is super anyway? Well, super is a tax-effective way to help you save, and everyone's probably familiar somewhat with that. But it's not exactly like having your own money, and you should remember that superannuation is not yours until some point in the future when you've met a condition of release. So it's important to remember that money that goes into super is there for one purpose and one purpose only, to fund your retirement. They call that the sole purpose test. So you can put money into it, your employer puts money into it, and over time that money grows in value through the power of compounding. It's a pretty good place to have money because it's a concessionally taxed environment, and during the contribution stage, where most of us are until we get up to retirement age, it's taxed at just 15% and even lower on capital gains. And that's true unless you're a very high income earner, where you start to become taxed at a slightly higher rate of 30% under what they call Division 293. But for most of us, it's taxed at a concessional rate of just 15%. And then later on, as you get towards retirement age, you can access your super once you've met a condition of release. There's really no early access unless there's specific reasons, and some of those include things like disability, where you can get access to your money early. And we saw during last year, during the COVID experience, that there was special schemes put in place by the government which allowed you to access small amounts early. And it's important to remember too that although this is money for your retirement, you can't do things like borrow money from your super. So the good things are it's concessionally taxed, which helps us to save for the long term. But obviously getting money out of that until you're near to retirement or at retirement, is deliberately difficult, and that's the trade-off. There are different types of super funds too, it's worth remembering, and there's some of the common ones here on this slide. For most of you listening to this webinar, you'll be members of a corporate super fund, and a corporate fund is one that's sponsored by your employer. It's put together by and members of a group in your company, and that allows you to get special discounts. It's cheaper to run, but there are other sorts as well, including retail funds, self-managed super funds, and industry funds. One of the lesser known ones, or one of the ones that are not included in that slide, which probably comes under the banner, are what we call wrap products, and wrap products provide a lot of the benefits of self-managed super funds, but can be controlled at less of a compliance burden. So that's another one that you might want to think about as well. So let's talk a little bit about how super plays a role in funding your retirement. And that role has changed over time. Going back to the early 1900s, when we think about what was the typical time spent in retirement, certainly at that point in time, life expectations were shorter. The average time spent in retirement was only about 11 years. But the challenge now for people who are wanting to self-fund their retirements are that people are living longer. And so not only do you need to think about providing a superannuation account with a larger balance, often people are not just living longer but wanting a quality of life that might be somewhat superior to what it was in the early 1900s as well. So we've got a double challenge there of trying to meet longer life expectancies with also our quality of life as well. So it begs the question, as we move on to this next slide, of how much is enough? And when answering that question, we've got to think about how long you want to live, or how long you are likely to live, what quality of life you're going to have in retirement, and where you want to live as well. What's the cost of living where you want to live? We can look at different websites to help come to an understanding of what quality of life you might get with your super. And I'm just going to bring up a little bit of an example now using the MoneySmart website from ASIC here. Now, there are many retirement planners that you can bring up on the internet. This one's from ASIC, but there are several that are available. I encourage you to have a bit of a look at these different illustrators. Bear in mind they are just illustrators, but they will give you some sense of how much money you might have at retirement and what sort of retirement that they might be able to bring you. So here's an example that I've pre-filled in on this MoneySmart website. This is an example of a 45-year-old with $100,000 of income with a desired retirement age of 65, who's single, $200,000 in super, and who's receiving just the 9.5% employer contribution, who doesn't have any plans to make an additional contribution. And it very quickly just calculates out what retirement looks like. So you can see here from age 65 going all the way through to age 89 in this case. And you can see here that the income in retirement is about $41,000 a year. Now in a minute we're going to have a little bit of a look and see whether $41,000 a year would be enough or not. But the other thing I want to show you is that you can see that that's made up of two components. In the early years, there's income from super completely, but as we go on, and you can see from the Centrelink age pension eligibility age of 67 in this case, there's a component that starts to be contributing towards income that comes from Centrelink. And that becomes progressively more and more as the superannuation balance declines until we top out on the maximum Centrelink allowance here at about age 83 all the way through. So remembering that your retirement income can be a combination of a part that's self-funded and a part that comes from Centrelink. And it's very simple just to tweak these little amounts. If you wanted to make an additional contribution, you could add that in there. You could put a monthly amount in there if you wanted to, of a certain dollar amount, and maybe that's $500 a month, and you could add that in and you could see what effect. And just $500 a month there, you can see has increased the annual retirement income up to $44,000. So there's some benefits there to becoming familiar with those retirement planners and having a little bit of a play with those simulators. And research has shown us that people who are more aware of their financial situation, become more informed, are both financially less stressed and ultimately do better as well. So I'd encourage you to have a bit of a go at some of those simulators just to get a sense of where you think you're going to end up. So let's now have a think about what does it look like in retirement at those different income levels. And to answer some of those questions, we're going to think about the research that was done by ASFA. And ASFA has come up with this research by surveying people on different lifestyles with different incomes, whether they were singles or couples, to come up with estimates of how much money they think might be suitable in retirement depending on the quality of life that you're looking to lead. So you can see here that they're saying, well, in this case, singles require a lump sum of $545,000 and couples require a lump sum of $640,000. And what this is saying, well, that's if you want to base the average budget and living standards for those aged around 65 to retire on what they're calling a comfortable living standard. But there are many, many variabilities there. First of all, do you want to retire at 65 or do you want to retire younger? If you want to retire younger, you're going to need to obviously provide a greater amount of money because you're going to need to fund a longer retirement duration. Do you want a better lifestyle than what they have termed comfortable? And exactly what is comfortable? If you want to have something in excess of that, again, you're going to need to have a greater amount at retirement. What about large expenses? If you have one-offs in terms of wanting to fund perhaps things for your children, if you want to fund one-off holidays, if you want to fund renovations to the home and things like that, that needs to be taken into account. And of course, the great unknown is what if you live longer? They've done this based on the median expectation of life expectancy, but obviously there's a great deal of variation around that. Some people live a shorter amount of time, some people live a longer amount of time, and it's usually impossible to predict what that might be. So there are a number of variables there, obviously. Let's hone in now and have a little look at what those ASFA amounts look like. And you can see they've got 3 columns starting from the right there, from age pension, the modest lifestyle in the middle, and the comfortable lifestyle on the very left-hand side. That example I referred to in the previous slide was in respect of a comfortable lifestyle. And you can see here the single requiring $43,000 and something a year, and the couple just about $62,000. So what's taken into account for a comfortable lifestyle? Well, a comfortable lifestyle, they're saying you can afford to renovate, replacing your kitchen and bathroom over a 20-year time frame, versus a modest lifestyle, really, there is no room for that. You can have a large number of household items and appliances, limited in the modest lifestyle. You can run air conditioning, not available in modest lifestyle. Restaurant dining, good range of quality food, whereas only takeout for modest lifestyle. Proper internet connection, decent clothes, domestic and occasional overseas holidays. You can afford private health cover, a reasonable car. Note that that's not 2 cars, it's a single car. And take part in a range of regular leisure activities. And again, note modest lifestyle means just one leisure activity. So they're pretty broad qualitative descriptions there, but it does give you sort of a benchmark and where you can see that is somewhat comfortable lifestyle. But you would need to make a decision, I think, really based on your own personal preferences, whether you can afford to be less than that or whether you need indeed something more than that. But that does give you something of a benchmark for your own consideration. Okay, so let's have a think about now consolidating your super. So consolidating super does have some benefits, and if you've got several accounts, the benefit of that is less paperwork and less fees, and that's always a good thing. So I think if you are in the position where you want life to be simpler and you want to pay less fees, consolidation is generally a good way to go. However, think through all of the issues before you do go and consolidate. And the number one thing is this point at the bottom of the paragraph here around cancellation of insurance benefits. That if you have a superannuation fund which is linked to insurance availability, and many of them do, particularly corporate super funds, if you cancel that super fund, you will lose your insurance benefit that may be very valuable to you. So think carefully before consolidating out of one of those funds, because you would lose your insurance benefits available in that fund. How do you go about finding what super funds you have? The best way is to have a MyGov account and to use that. The MyGov account is extremely useful for a number of reasons, not just for consolidating your super. And I would encourage everyone, if you don't have a MyGov account already, to get one, and to start using it and to play around with it and just have a look at the functionality. So first and foremost, when you get your MyGov account, you link it to the ATO, and then once you've done that, you go into the ATO part of the MyGov, and within that you'll see a menu which allows you then to access the super elements of the ATO website. In that, it'll give you a listing of your super accounts, and you may have just the one or you may have several. If you've got several, that's where it'll also give you the option to consolidate your super if that's what you want to do. It'll also note whether one of those super accounts has insurance attached to it as well. So that will help guide you in respect of the consolidation. I would encourage you, if you're uncertain there, to seek financial advice. If you need assistance in deciding what is the best way to consolidate or which ones you should consolidate to as the preferred account of choice. So always seek advice if you're unsure. The other interesting and useful part of the ATO website in the super category is that you can track your different types of contributions. And we're going to talk a little bit in this presentation about carry forward and bring forward. All of those different types of contributions are outlined in the MyGov ATO website. So that's very useful for keeping track of that sort of information. All right, so let's get into the part where we're talking about how to boost up your super. And now is the best time. We're a couple of months away from the end of the financial year. It's always good going into the end of the financial year to think about ways to get your super up and potentially save tax, which some of these are ways of doing that. We're going to look at salary sacrifice, making one-off contributions, how we can utilise benefits from the government to incentivise us to boost our super, and also how to work with a spouse to boosting their super and also gaining benefits in the meantime to doing that. In every case here, remember that we are working within the legislative environment where contributions are subject to caps, both what we call concessional and non-concessional caps. So the concessional ones are those that we receive a tax deduction for, or those that we can make from our pre-tax dollars, and non-concessional where we make those contributions from after-tax dollars. So always be aware of those limits. Again, if you're unsure, please seek advice. Okay, so first of all, what's the point of using super as a savings vehicle? And the main benefit here, as I referred to earlier, is the tax saving. So if you look at the personal income tax rates on the left-hand side of this slide, you can see that very quickly, after you've got through the first tax-free bracket at 18,200, we're into tax rates from 19% up as high as 45% that are all in excess of the accumulation rate available in super of 15%. And what that means is that when you are contributing money that is tax deductible into super or is able to be contributed from pre-tax dollars into super, you're always going to be at a tax advantage. And hence why there are limits on how much you can contribute to super in that way. So that if your current income, let's say, is between $45,000 and $120,000 and you're subject to a tax rate at 32.5%, if you make contributions to super from pre-tax dollars and you're in that bracket, those contributions in the fund are taxed at 15% rather than taxed in your hand at 32.5%. So you're actually making a saving of 17.5% there. Of course, the other thing that's really worth mentioning here is that later on, when you reach retirement and you can go to pension phase, then those amounts in super are going to be taxed at 0%. And that is the big benefit that we're all really saving towards later on in life. That's not going to be the case for monies that are saved outside of super, which will still be subject to the tax rate applicable. You know, if it's in savings in your personal name, then those earnings inside a non-super environment will be taxed still at your marginal tax rate. So the only exception to that 15%, as I mentioned earlier, is if you're subject to high income above the Division 293 threshold, which is currently $250,000, then you're taxed at 30% inside the fund. So let's have a little bit of look at the caps that I mentioned. So you can make up to $25,000 of contributions from pre-tax dollars into your super fund, what is called a concessional contribution. And I just want to draw to your attention here that there are a lot of components that go into this cap. So first of all, your employer's statutory guaranteed amounts, the employer contributions contribute towards that, and any salary sacrifice amounts that you already make via your payroll go into that. It's also worth mentioning that if you have employer-funded insurance premiums from your corporate super account, those employer-funded insurance premiums will also count towards that if those are being paid for via your superannuation fund. So just be very, very aware of what amounts are already going into that cap and what your headroom is available to make additional contributions. If you're unsure, seek advice before you proceed to make additional contributions. Worth noting that as of 1st of July, that contribution amount, that cap limit will go from $25,000 up to $27,500. Then if we look at what you can make from your post-tax dollars, a non-concessional contribution limit of $100,000 per year. And this is sometimes useful, for example, if you were to receive a lump sum of money, for example, a bonus, an inheritance, or some other windfall perhaps, you can make a contribution up to that amount into your super fund. You can't claim a tax deduction for it, but neither is it taxed when it hits your super fund. So that's the other positive side to that. That limit is going up to $110,000 from 1 July. So again, we'll be able to make even more significant contributions in the following financial year. Okay, so this is pretty much ground that we've covered already. And I'll just note here at the bottom of this slide, in respect of the concessional contributions using the $25,000 a year, there is this strategy available now whereby unused contributions can be used in future years over a 5-year rolling period if your super balance is under $500,000, and we call that the carry forward. Now, I've got an example coming up later. I won't go into that just yet. I'll wait for the example, but that's just worth noting. So if you've had 2 or 3 years where you might have only contributed, say, $20,000 out of the 25, and you've had that deficit of $5,000 or so, that hasn't gone to waste. You'll be able to utilise that unutilised cap amount, and we'll go through that example in just a minute. Okay, so let's go through some specific examples. And the first one here is salary sacrifice. So I think a lot of people have already been pretty used to this. And this is the simplest way of getting money into super, where you just organise through your payroll to make a contribution to super from your pre-tax dollars. It's a great way to do it because oftentimes you don't even miss the money when you put it into super first. It's very tax efficient for the reasons that I've gone through already. Just bear in mind those contribution caps. I think it's worth noting here that there is the first homeowner super saver scheme that will be applicable for some of our younger listeners to this webinar. I'm not going to go into a lot of detail on the first homeowner super saver scheme here. But please go and research that yourself. If you have not bought your first home yet and you're looking to use superannuation as a tool to help save for that, please have a look at that, because voluntary contributions up to a maximum of $15,000 per year can be utilised as a way of saving for your deposit on your first home. So it's a good little strategy where super can come into play there, but please go and have a little look at that if you are thinking about using super as a way of saving for your first home. So here's a simple strategy example where Michelle, age 45, earning $80,000 a year, is receiving SG of 9.5% or $7,600 a year, wants to build up a super and has saved up $11,000. She could put that $11,000 into super as a non-concessional amount after tax, but instead decides to use salary sacrifice and puts in close to $17,000, just under $16,794 from her pre-tax salary instead, and that actually results in a larger amount going into super, but only $11,000 is the net effect from her after-tax income. So her take-home pay remains the same, but she's got more money going into super. So that's a really good example of the pre versus post-tax effect of using salary sacrifice and getting more money into super. So I did mention to you earlier about this catch-up contribution strategy, and starting from last year, it's also obviously eligible for the current financial year. This applies to anyone who had a super balance less than $500,000 on 30 June last year, so 30 June 2020 in our case. And basically, you can look for periods starting 1 July 2018 going forward. Any non-utilised concessional cap amounts can now be added up for up to 5 years, and you can make a personal deductible contribution and utilise that in addition to your $25,000 cap. All right, so this is great. And when might you use that, for example? So let's say that you had time off to have a baby. All right, you weren't at work, you didn't utilise your concessional cap at all. Perfect time to actually maybe utilise the whole $25,000 that didn't get utilised at all last year. Maybe you were made redundant in a job and you were out of work for some time, or you were changing jobs and you were out of work, or due to COVID you were working less and you had less SG going into your super for a period of time. So really this is a great strategy where you've had a break from work, you haven't had money going into super, and you want to catch up again in a future period. So remember, there is an expiry of 5 years on this. So as long as you get on top of it within 5 years, and you've got the surplus, money available to put into super, you're still saving tax, and it allows you to utilise more than the current $25,000 cap in any 1 year, as long as your balance is under $500,000 in the previous year. Let's have a look at another more advanced strategy on the non-concessional contributions. Now, I mentioned to you that it's $100,000 a year. There is something that we call the bring forward rule, so not to be confused with the carry forward rule, but this is the bring forward rule, where you can actually utilise the current year plus 2 future years limits all in the 1 year and contribute up to $300,000. Now, this is eligible if as long as you are under 65 and you are not over your total super balance of 1.6 million. So there are some sort of finer grained details here. We would always encourage you to get advice around this, particularly if you are approaching age 65. Be sort of cautious of that, or if you are approaching your total super balance of 1.6 million. There are different rules that tend to start to kick in around those two factors. But in essence, you can contribute 3 years worth in one go. And this might be useful, again, if you had a significant windfall and you want to get a big chunk of money into super in 1 year. Bear in mind, that would mean that in years 2 and 3, you can't put any further non-concessional money into super, because you've already utilised those amounts up. So do be careful not to utilise the bring forward rule and then continue to put money in the following 2 years. I would also remind you that the cap is going up to $110,000 next financial year. That doesn't mean you can put in $100,000 for this year and then $110 for the next 2 and make it $320. It's still $300 for this year. So don't get tricked into thinking that it's a bring forward of $110 and $110. It's still just 3 times 100. Next year, next financial year, after 1 July, you'll be able to do 330. But it doesn't work that you can put in 320 this year. So again, it's a more advanced strategy with some limitations, as I mentioned, so please seek advice if it's something that you want to look at utilising and you're unsure about that. So I've just got a couple more quick strategies before we finish for the day. And to me, these are absolute, what I call gimmies, particularly if you're in a married or if you're in a de facto relationship. You can utilise these next 2 very effectively if you have a low income or non-working spousal arrangement, or if you indeed yourself are in a low income situation. So the first is what we call a government co-contribution. And if you earn less than 50, it says 52,000 on the slide. The current limits for 2021 are 54,837. The government will top up your super with $500 if you make your own personal contribution to super, and that's $1,000. So to me, this is an absolute gimme. The lower threshold, what we call the lower threshold, where they make a full top-up, is below $39,837. So again, ideal if you have a non-working or a low-income partner perhaps. Put in $1,000 of non-concessional contribution, the government's going to put in $500, and that's a 50% return on your money. So it's a real easy win there. It's basically a government handout, and I would encourage anyone that is in that situation to think seriously about putting aside some money for that. There's lots of available information on the ATO website for that, and so please read up further on that if you need specific information or again seek advice. The last one here is in relation to spouse contributions, and this allows you to put money into your spouse's superannuation account where your spouse earns less than $40,000 per annum. And you can, in this case, put in monies. The full amount is when they're earning less than $37,000. But again, here we get a tax rebate up to a maximum of $540 when you put in a $3,000 contribution. And this is like an 18% return on your money. Again, it's a great gimme from the government. So there is a shade out between $37,000 and $40,000, sorry. So if your spouse is earning less than $37,000, you'll get the full 18% tax offset there. In other words, a reduction in your tax bill. So that's another great little one. Again, refer the ATO website if you need more information on spouse contributions. But it's a good way of boosting your spouse's super and getting a great tax offset for yourself at the same time. Okay, everyone. Well, that's all the information we have today on this webinar. I hope you've enjoyed the webinar, and a lot of ideas there obviously thrown at you in a very short period of time, but hopefully that gets you started and gets you started thinking, and plenty of time to get some ideas together before 30 June. Thanks for your time today.